stock, you heard from Ken Rogoff saying it would be suicide to raise rates right now. But in an op-ed in today's Wall Street Journal, David Malpass recommended the Fed should raise rates to avoid asset bubbles. To talk about this and many more topics today, we're joined by Alan Sinai, Chief Global Economist at Decision Economics. Great to see you.
Nice to see you.
So first, give us your take on the Fed's role here. Do you even think the Fed is caught between a rock and a hard place by way of interest rates and monetary policy?
No, not at all. The Federal Reserve, when they decide to raise interest rates, will head back to some normal level. And taking interest rates from 0 to 50 basis points, 75 basis points, that's the funds rate, to even 1.25 over time, that isn't going to make any difference at all to anything going on in the economy. They have a lot of room to move to higher interest rates from where they are to restore normalcy without upsetting the apple cart. So, no, I don't think they're stuck at all.
But what about these concerns that these low rates that we've seen for an extended time already could lead to asset bubbles? Fed President Bullard just moments ago was commenting that there's a lot of discussion to be had. Our Tom Keene, our economics editor at large, says the challenge is to get ahead of these asset bubbles. What is your thought on that?
Oh, I do think the history of the Federal Reserve waiting until an asset bubble is in place and then the price bubble bursts and picking up the pieces afterwards is a mistake. And they do need to raise interest rates and lean against potential asset bubbles. The problem is identifying potential asset bubbles, and what's going on around the world and has gone on around the world so far, while everyone is so asset price bubble sensitive, to us, we're not seeing bubbles anywhere at this time on any of the standard measures by which one would calibrate that. So it's a little early to start to lean against bubbles that aren't there, but they shouldn't wait. That means what I'm saying is our central bank should raise interest rates a little sooner than most people expect. It isn't going to hurt anything, and it will help damp down too much speculative enthusiasm.
But haven't we done a crummy job detecting asset bubbles before they burst in the past in many occasions?
On standard tech, when you're in one, I think you know one. Those of us who are in the world of markets and business, you can kind of feel it. There's a lot of descriptive information that has gone on in all kinds of asset bubbles, and it's not so much in the hard data or even in the price movements themselves, but it's in the enthusiasm, the speculative fervor, the behavior, the herd instinct of people in the markets. And people who are in the markets can feel it, can identify it, and indeed, we think we have known it in the two big asset price bubbles we've had in the last decade, the stock price and dot-com bubble of the 99, 2000, and the housing price bubble, real estate bubble, credit bubble, and the bubble in stock prices of this last episode. We're absolutely sure that we can tell before it bursts that it's happening.
I want to move on to the jobs report today. Of course, the headline numbers are an improvement better than expected. The payrolls lost much fewer than forecast. But if you look under the hood of the report, there were some concerns, namely in the average weekly hours. So I'm curious for your take on the report and what it says about where we are in this economic recovery.
Well, the first thing it says is we're in a different place in the jobs market. Thank God. We're no longer in the collapse crisis stage, throwing people out of work. We're in a much better place. That means, I think, non-farm payroll will bounce around between minus 100 and plus 100 going forward, and no more minus 2, 3, 400,000. And by the way, no pluses of 200,000 or so, or even more than 100,000, which is what we need to get the unemployment rate down. That's fundamentally very positive. It's still a terrible jobs market. Huge supply of labor, huge pool of unemployed workers, a lot of downward pressure and compensation. I don't think consumers are going to feel better on this one employment report. Consumer spending will still be tough, and that means the U.S. economy will grow very slowly.
Alan Sinai, thank you for your comments today. Appreciate it.
Thank you.
And